Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.
Inflation for last month is 8.5% for year over year. Disney overtakes Netflix in streaming subscribers. And are we in the crosshairs of a recession? We have that and more tonight on this Friday, August the 12th, 2022. Hi, I'm Andre Laborde, and welcome to Wall Street Wrap Up on this Friday, August the 12th, 2022. I hope your week went well. Well, this week, the government came out with their latest consumer price index numbers for July. This measures the inflation gauge of items as the cost of gas that we put in our tank to what we pay at the grocery. Well, coming up, we're going to be talking about the possibilities of a recession, the rising costs of those who may be thinking about buying a home. Or are you concerned about using your savings just to keep afloat? Well, coming up, we're going to be talking with Tyler Goodspeed. Tyler was the former chairman of the Council of Economic Advisors at the White House. And now he's a professor of economics at Stanford University, where he holds the Kleinheinz Fellow Chair at the Hoover Institute at Stanford. Tonight, Tyler Goodspeed in just a moment. But first, consumer prices were released this Wednesday, and for the first time, instead of inflation going higher each month, it actually plateaued for the first time in 18 months. Now, that was very good news for the market, and it helped with all the indexes for the week. Now, if you've been to the grocery lately, you don't need me to tell you that prices are going up. For July, eggs are up 38%, cereal is up 15%, and coffee, which we all need in the morning just to digest these numbers, is up over 20% from last July. Energy is also rising for the year. Gasoline has risen 44% for the year, as well as fuel oil is up over 75%. Followed by natural gas at over 30%, all since July of 2021 to last month. But first, how did the markets do this week? Well, with these good economic numbers released on Wednesday for inflation going down, it actually helped to rally the market. All the indexes ended in the positive for the week, and the S&P and the NASDAQ actually had their fourth straight week of gains. And this week, the Dow Jones ended at 33,761, which was up almost 3% for the week. And the S&P 500, they closed at 4,279, which was up 3.25% for the week. And the NASDAQ, well, they ended at 13,047, which was up just over 3% for the week. Now, Target is going to be reporting their earnings for the second quarter next week. And Michael Lasser, the retail analyst at UBS, he has a new price target on target at $205 a share. And Barton Crockett of Rosenblatt Securities is raising the price of Target raising their target, I should say, of Disney to a buy and a price target to $124 a share after they came out with strong earnings this past week. And Disney closed today at $121.56. Barton also raised the price targets of Six Flags and SeaWorld to a buy, and both of these stocks, Barton Crockett of Rosenblatt Securities, will be joining us as a guest in a couple of weeks to talk about these stocks and more, just as a heads up. Now, let's get to our guest this evening. Tyler Goodspeed, he's the former chairman of the Council of Economic Advisors and is now, instead of advising the president, he teaches economics at Stanford University, where he's a Kleinheinz Fellow at the Hoover Institution. And best of all, he's here with us tonight. Hi, Tyler. Welcome to Wall Street Wrap Up.
Good to be with you, Andre.
Tyler, this week, the Consumer Price Index came out, and I have to say it surprised a lot of people. I know it certainly did me, especially because of the week before we had such high job number growth that came out that spooked the markets. But it looks like we went from June of an inflation rate of 9.1% to this week for July of reporting of about an 8.5% year over year. Was it a surprise to you, or did you have thoughts that this would be the numbers?
The fact that it slowed by as much as it did surprise me a little bit, but there were a number of factors that were going on here. So one thing is the so-called base effect. So we had some big month-over-month increases in inflation a year ago in 2021 that start to drop off the calculation. There are also some of the transitory factors that were really driving inflation in much of 2021 and early 2022. Items like used cars, some pandemic-affected services, energy was another one. Those started to come down in July of this year. But on the other hand, we do continue to see a lot of inflationary pressure in services, and that's going to be a challenge moving forward.
I would think, Tyler, because of gasoline prices, is probably, in my thoughts, if not the most important, but certainly maybe one of the top three, because fuel costs. I mean, I know business owners that are talking about how they have a fuel surcharge on the products that they have delivered today. So once gasoline and fuel goes down to a manageable level, that may help inflation the way it is?
So certainly energy prices coming down is going to help, and it's one of the prices that consumers certainly pay the most attention to, and it does kind of filter through into a lot of other goods and services. But at the end of the day, the single biggest component of consumer price inflation is rent and owner equivalent rent. So the equivalent of rent for if you were paying rent to yourself as a homeowner. Mm-hmm. And that is about 40% of core consumer price inflation, 30% of overall consumer price inflation. And I think the concerning thing is that's continuing to rise at a month-over-month pace of like 0.6, 0.7. And so we have a lot of inflation that's sort of already baked into the cake just from the cost of housing.
With rent, mortgage rates, home sales are slowing down. And it sounds like the Federal Reserve wants to have slower home sales. And of course, they're going to win the battle when it comes to inflation, I guess, because they can always raise interest rates. But the question is, at what cost? So, and will it be within how much of a certain time zone will it be until they win the battle inflation? And also, I would think, would it bring across a recession? We have a recession in the horizon.
So a number of good points there, good questions there. So in terms of housing cooling, yes, look, housing is one of the most interest rate sensitive sectors in the U.S. economy, in any economy really. And the easy monetary policy of 2021 was really inflating asset prices, including housing. And that's why we saw double-digit gains in home prices in 2021 into 2022. That's going to start to cool a bit. But even as that cools, the way they calculate rent and owner equivalent rent means that past inflation is actually going to increasingly enter into the calculation of consumer price inflation. But even as those housing prices ease, one thing that we've seen in the past is that people tend to substitute away from home ownership into renting, and so rents can continue to be quite elevated. In terms of this question of, can the Fed pull off disinflation without triggering a recession? Their track record in the post-1945 period isn't that great. And I think when we look at what the National Bureau of Economic Research classifies as a recession, depth, duration, diffusion, increasingly we are sort of seeing a lot of signs that we may be in the foothills, trespassing on the foothills of recession.
With the Treasury bonds, they have what's known as an inversion curve. And normally, a yield that pays on the 10-year Treasury pays more than on the 2-year Treasury. Except when the yield on the 2-year Treasury pays more than on the 10-year, it's sort of an anomaly, and that's known as an inversion curve, because the thought is that the longer you keep your money in, the more interest rates you'd get. And normally, when that happens, that's preceding a recession. And it just happens, Tyler, that this has been occurring, where the yield on a 2-year Treasury has been going higher than the yield of a 10-year. Do you put any faith into this inversion curve theory?
Well, certainly, historically, yield curve inversion has been one of the most reliable indicators of recession over the next 12, 18 months. available. And actually that held true again in 2020 when the yield curve inverted in 2019, and then we had the pandemic recession. But I wouldn't say that that was attributable to market foresight of the pandemic. I think the yield curve inversion we need to be cautious about today because the yield curve has been kind of distorted by actions of the Federal Reserve. So as the Federal Reserve starts to pare back some of their monetary easing, that's going to impact the shape of the yield curve.
Do you think also that now the last two times that they've met in June and July, they've raised interest rates 75 basis points, 0.75%. Now, we've got another meeting coming up in September. I don't think we have one October, so I think we've got one September, November, and December for the remainder of this year. Do you think with the numbers that when we started, you and I talking just now, we were talking about the CPI, Consumer Price Index, came out this week, and last week with the very hot job numbers coming out, do you think this seals the deal for another 0.75%, 75 basis points for when they meet in September?
So I don't think anything seals the deal. My base case, given the dovishness, or what I perceive to be dovishness, given the seriousness of the inflation problem a month ago in the Fed's remarks, I would probably, as base case, bet that they go 50 basis points next month when they meet next month. But my worry is that, if the 1970s are any guide, the Fed has a track record, unless your name is Paul Volcker, the Fed has a track record of pausing a tightening cycle before they've gotten inflation expectations back under control. So in the 1970s, we saw multiple times the Fed said, look, we're going to get inflation under control. This is it. And until Paul Volcker came along, each time they either paused or did a U-turn. And so I worry that they might do the same in the next year.
Tyler, inflation is too much money in the system chasing too few goods. Well, just as recently, this past week, Congress passed and the president signed a CHIPS bill that I think was like $38 billion or $40 billion CHIPS Act. And then also they just passed it's now I think going to the House after passing the Senate, about a $370 billion, what's called an Inflation Reduction Act. So if you add in more money, let's say about $370 billion for the Inflation Reduction Act, their words, not mine, and also this CHIPS Act, this is going to be a lot more money into the system. Do you think that's going to actually exacerbate and maybe prolong a possible inflation and hopefully not a recession?
So, I've long adhered to what I call the Hippocratic Oath as applied to economic policy making: first, do no harm. I do worry that a lot of the spending provisions in this bill precede the revenue increases and the deficit reduction, because there's some gimmicks going on that they extend some subsidies for a couple of years, but we all know that they intend to extend those indefinitely, or in their hopes make them permanent. So there's this flow of spending and then sort of a promise of deficit reduction later. But look, this spending is a lot of subsidies, and I don't tend to think of subsidies as inflation reducing, especially if you're doing some drug price negotiation that reduces drug prices for some recipients, and then that just drives up the cost for uncovered consumers of pharmaceutical products. And then, in terms of longer term, when you're taxing the formation of capital with some of the corporate tax provisions, then I think you're long run lowering the productive capital stock of the United States. And that's not good from a supply side perspective in terms of reducing inflationary pressure in the long run.
And I imagine, Tyler, what you're talking about there is that there's now a corporate minimum 15% tax on corporations of annual of amounts of $1 billion or more. But also there's another interesting part on there where now there's a 1% tax on stocks, companies that do stock buybacks. And Is that also what you're talking about right there about this, the 1% tax? And also, I'm curious, you've been around government long enough, Tyler. Once government gets their foot in the door, let's say with 1%, it's just only 1%. When do you think that will become 2%, and then 3%, and then 4%?
That's a great question. Rarely do we go in the reverse direction.
Yeah.
And so and also it's sort of baked in with the minimum corporate tax, because that $1 billion threshold is not indexed to inflation. So that is going to catch more and more firms as time goes on. Mm-hmm. In terms of the 1% buyback tax, it sounds great to say, oh, we don't like buybacks, we're going to tax buybacks. But buybacks are actually the way in which firms without profitable investment opportunities return cash to shareholders so that can then be invested in other firms, typically smaller, more dynamic firms that do have profitable investment opportunities. So it's a way to move capital around the economy to where it can be most productively deployed. And I worry that the more you start sort of taxing that reallocation of capital, the more you're going to ensure that cash just remains stockpiled at a few highly profitable incumbent firms like Google, like Apple, like Facebook, like Amazon.
Do you think, Tyler, that with this 1% tax on companies that want to buy back their stock, do you think this may hinder a company from doing it, or do you think they'll be glad to pay the 1% and do it? Also, I'm curious is that whenever this starts, do you think that you'll see a lot more buybacks before to get it in before the deadline?
Oh, I would have to imagine that we'll see a surge in buybacks before it kicks in. Mm-hmm. And at the margin, again, economics is all about the margin. At the margin, some firms who would otherwise distribute cash to shareholders via share repurchases, at the margin, some firms that would otherwise do that now won't, because there are some reasons why you might want to do a share repurchase rather than a dividend payment, because dividend payments tend to be very sticky. It's hard for firms to reduce dividend payments in the future if they need to. So that's one reason why they prefer share repurchases. As I said, we tend to think of capital reallocation, moving capital to where it can be most productively and efficiently employed, tends to be a good thing.
Tyler, I'm curious your thoughts. Right now, we're into third quarter of the year, and we're getting numbers in from companies that are reporting their second quarter earnings. Many of them are hitting their numbers, and some are not. But I'm curious if you're thinking that because of the inflation, the way it's been, do you think it's because these companies are selling more products and services, or do you think it's because they've had to raise their prices enough to be able to keep up to date with inflation that it's looking like they're making more sales when actually they're selling the same amount of goods, they're just raising prices?
Interesting question. So there are two factors here. One is real wages have been declining. Mm-hmm. So yes, we've seen big nominal wage gains, but those have not been sufficient to keep pace with the pace of inflation. So prices have been going up by so much more. And part of the reason for that is just, a lot of prices tend to be much more flexible than wage contracts, which are set annually or sometimes even less frequently than that. So that would tend to enhance corporate profits, business profits. The other factor is that given the magnitude of the demand stimulus in 2021, I mean, the stimulus in March 2021 was equal to 10% of the annual output of the entire U.S. economy. That's a lot of stimulus. And I think that's why we saw a big surge in nominal demand in 2021 and continuing into 2022. But the supply side of the U.S. economy couldn't fully keep pace with that. And so you're right that even though nominal retail sales are still far above trend, they've come down much closer to trend in real terms, real inflation adjusted terms. And that's because the supply side just it struggles to cope with a demand of that magnitude.
We're talking right now with Tyler Goodspeed. He is the Klein-Heinz Fellow at Hoover Institute at Stanford University. We'll take a break. We'll be right back. glad to be back. We're talking with Tyler Goodspeed. Tyler, before we went into a break, you brought up an interesting point about how inflation is, or I should say maybe the hourly wage gains of employees are not keeping up with inflation. And that's a great point because inflation for July came out with the consumer price index this week, and it's at about 8.5%. But hourly wage gains for the last year, I think, is about 5.2, 5.3%. So you're looking at about a 3% loss unless an employee is getting raises from their employer, which I doubt very many are. More and more people are digging into their savings to go ahead and keep up to date with inflation. What do you see as a progression?
This, first of all, in terms of the magnitude of this decline in real wages, there's been an absolute decline in real wages, but also there's been a decline relative to pre-pandemic trend. And if one looks at the sort of best measure of average earnings, the employment cost index, and adjust that for inflation, it suggests that average real wages are down about 6% below pre-pandemic trend. And the one saving grace had been that even though average wages were declining, wages in the aggregate were going up because we were adding so many jobs. But in the most recent months, in 2 of the past 3 months, that actually has no longer been the case. So in the aggregate, real compensation of employees has been going down. And I think that's one reason that we saw big job gains last month and the preceding month, was because there's kind of an incentive to continue hiring and to hold on to labor, because labor in real terms is actually getting cheaper because of the big inflation that we've been seeing. In terms of consumer savings, yes, in light of this decline in real purchasing power, we have started to see households really have to tap into savings. And, fortunately, they had accumulated a lot of savings in 2020 and 2021 because of the COVID relief and stimulus packages. But that sort of tapping into savings can only continue so long. So I think that's one reason why I do expect the pace of consumer spending to start slowing from here. And it already has started to slow when you look at consumer spending on goods.
There was a recent report I saw from the NFIB, National Federation of Independent Businesses, and something struck me, Tyler, is that they asked business owners what were the three biggest issues that were concerning them. And I can understand, one was inflation, totally understand. Number two, or the third one was taxes. But the second one was surprising me was that it was quality of labor. And it wasn't and Tyler, what surprised me was not labor, just like a warm body, but now employers are going, wait, the quality of the labor. Do you think they're becoming more selective and just going, I just don't want a warm body to fill that seat, but somebody that I could really, as a long-term participant in my business?
I'm glad you mentioned the NFIB survey, which is a great, very helpful monthly survey, because one really surprising thing about that survey in recent months is that if you look at the question, do you expect the economy to improve? That is actually at recessionary levels, and I think it's the lowest it has been since the 1970s, if not ever. And one of the reasons, yes, is this issue of labor quality. And here, I think that there's a very interesting development in the U.S. economy over the past 2 years, and that is the early retirement of baby boomers. And by my estimates, about 1.5 million people over the age of 55 took early retirement in 2020 and 2021. And that's an adverse shock when that hits, because you're removing from the labor force 1.5 million Americans who have a lot of accumulated human capital, a lot of skills, a lot of experiences, and that's difficult to replace in the near term.
I read an interesting article about a week ago. Again, I think it was in the Journal, or it might have been in Bloomberg. But it was that the Biden administration is thinking about lowering the standards to help increase first-time home buyers. And they're using FHA for lowering the standards to being able for first-time home buyers to qualify for homes. Now, my first thought was, I remember very well the 2005, 2006 real estate crisis, where you had people were in addition to no-doc loans, or what was also known as liar loans, people were buying real estate that was really above their beyond means. Do you think that this is going to be another problem coming up in the near future or the foreseeable future if this occurs?
Well, without knowing the details, I would say it does ring alarm bells in my mind when government starts to intervene in mortgage markets even more than they already do, and in particular to sort of intervene in mortgage markets in manners designed to subsidize or otherwise incentivize taking out mortgages and bigger mortgages. I would be focused much more on improving the supply side potential of the U.S. economy and improving the supply of housing rather than trying to subsidize demand, and in particular demand for mortgages.
I had thoroughly enjoyed it. I hope you come back for more.
Likewise, that'll be great. Enjoyed talking with you, Andre.
Thanks, Tyler. Well, if you've got a question about finance or a comment about the show, we'd love to hear from you. Make it pithy, make it concise, and write us at andre@wallstreetwrapup.info. And now for a look ahead of market information for next week. But first, what did IBM introduce on this day in 1981 that revolutionized technology? Well, we've got the answer in just a moment. Well, what did IBM introduce in 1981 on this day that revolutionized technology? The PC was born, the personal computer. It listed for $1,265. It came with 16 kilobytes of user memory. And for $90 more, you can expand the memory of another whole 16 kilobytes. Well, finally, on Wall Street Wrap Up, are you planning a trip, whether for business or fun or maybe for the family? Well, next week, you don't want to go until you watch next week, because we'll be talking with a travel advisor, Mark Murphy. From airline cancellation, flights at airports, to hourly delays at the airports, just sitting on the tarmac. What are your rights? Or do you even have any rights? How do you get an upgrade at a hotel? Airline flight upgrades and cruises, what about those? That's next week. My guest, travel advisor, Mark Murphy. You don't want to miss it. And as a reminder, we repeat the show on Sunday mornings. But the best way, set your DVR so you'll never miss an episode. And that's our show for this Friday, August the 12th, 2022. I hope you enjoyed it. My thanks so much to Tyler Goodspeed for joining us this evening. But always, it's you. We appreciate you for allowing us into your homes tonight. So remember, follow us on all the social media, on Facebook, now known as Meta platforms, and YouTube and Twitter, and WYES.org. So have a great weekend ahead and a productive week as well. I'll see you next week. So for Wall Street Wrap Up, I'm Andre Laborde. Remember, money never sleeps. Good night.
Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.